Okay, dear students, so today we are going to start non-current assets, IFRS 5, non-current assets held for sale and discontinued operation. Just for introduction, you guys have studied this standard before in your life, but yes, we will go right from the scratch, truly from the scratch. First thing, for example, you bought a non-current asset like 3 to 4 years ago, and you know there is a life of 10 years. Let us say the life of that non-current asset is 10 years, so you started depreciating it on the basis of straight line method or any method. Okay, but after 3 years you decided to sell the asset. So now you don't have any intention of usage, you have intention to sell it. So now you will get benefit from that asset, not by using it, by selling it. So IFRS 5, this standard says now you should classify this asset as a current asset. Now this asset is no longer a non-current asset. So please shift this asset to current asset. This is the basics. This is the basics. Okay. Now see the screen. Old standard, there was when there was no IFRS 5, like years back when there was no IFRS 5, there was old standard only used to deal in discontinued operation. But now this new standard deals with single asset, okay, as well as disposal group and as well as operation. New standard deals with all these three things. Single asset means any machine, any building, any single asset. Okay. Disposal, what do you mean by disposal group? Disposal group means if I combine two assets or three assets or one liability and sell all these three or four in one shot, one transaction. I repeat, disposal group means combination of two, three assets or a liability, and we are going to sell it in one shot, one shot all together. Okay. And finally there is a word operation. Operation means you recently you did IS 36 in your last classes, remember? So you studied operation is like CGU, which generates cash flow independently, Okay. So if you go through the IFRS, the main IFRS book, yes, there is a difference between disposal group and operation, but normally in your course, examiner uses these two interchangeably. Okay, right? So this was the brief history of the old standard. Now just think what I just told you, that you bought a non-current asset for usage and you use it for like 2 3 4 years, but after 2 3 4 years you decided to sell that asset. So now if your intentions are to sell it, so standard says you don't need to record it as a non-current asset, kindly shift it to current asset and report this asset as a current asset. Okay. So first of all, this is the definition of held for sale. This is the main definition you must know. Okay. In the examination sometime you need to write it. Asset whose carrying value is principally recovered through a sale transaction, not from continuing use. Okay. So now the major benefit you will obtain from sale of that asset, not from usage. Okay, right? But one question comes in your mind, that if standard board says, if IFRS 5 says, okay, whenever you want to shift non-current asset to current asset, you can just it's just your intention and you can just shift it. So people will do creative accounting, accountants will do manipulation, accountants will be doing creative accounting then. Okay. So standard says you must meet some criteria. What is the why accountant will do? As a student you may ask, why accountant will do creative accounting? Listen, if I shift a non-current asset to current asset, then obviously my liquidity ratios like current ratio and all will be improved. So if I do such planning that at the year end I say that I want to classify this asset, non-current asset, to current asset, so I'm shifting it to current asset and later on I'll reshift it to non-current. So this will be creative accounting. So standard says that you cannot do this blindly. You cannot do this blindly. You have to fulfill certain criterias. And yes, we are going to discuss that criteria. If you meet that held for sale criteria, then only then only you can classify that as that non-current asset to current asset, that non-current asset to current asset. Okay, now these are the conditions for held for sale. These are the conditions for held for sale. The first line, see the black marker, it is written asset must be ready for sale in its immediate condition. Ready for sale means if a buyer comes now, you just give it, that means it is in immediately sellable condition. The asset must be in immediately sellable condition. Okay, now there are some interpretation. See the red marker of this first point. I have written some explanation, some history, even some history from the past papers. These things came in past papers, so I can recall you here. The first thing is substitute of that asset is ready. For example, listen. If that asset, case number one, if that asset is a surplus asset, extra asset, you are a very rich guy, you are a very rich company, and you have many extra assets, surplus asset. Okay, so if you are saying that I want to sell this surplus fixed asset, if you are saying that I want to sell this surplus fixed asset, then in that case, standard won't ask, auditor won't ask you any substitute. He will say okay, you can classify it as held for sale. But if it is your primary asset, used in your productions, so now you definitely have to show a substitute. For example, let us say right now I am in my physical campus. For example, I am in my physical campus and this is my only campus from where I teach. Okay, so if I say today that I want to classify this asset as held for sale, it means I want to close my operations. So auditor will ask, where is the substitute? Now where will you teach? So I must show a substitute asset. Okay, so in the past paper, in the history of the examination, you have to present a substitute asset if it is your primary asset. Okay, read the line, be active please. Substitute for asset ready if this is the only asset in operation, but if it is a surplus asset, then no need of substitute. Now the second point is no repairs due. Yes, for example, in the past paper, many years back, I would say, the examiner tested a question. The name of that question was rock buy, and in that question, there we had a building, and we were saying that we want to classify it as held for sale. We want to classify it as held for sale. But in the same question, it was written that before the year end, there was some subsidence. Some subsidence came in the building. Subsidence is like some problem with the leakage and all in the walls and all. So it was written in the question. Now we have to first repair it. Now first we have to repair this asset and then only we can sell it. So now it's not held for sale. Now it's not held for sale in its present condition. Now it's not held for sale in its present condition. And in the examination, we wrote this comment. Okay, so be careful if some repairs are due, so that means it's not held for sale. Now the next thing is no backlog orders. Yes, for example, I have a machine and that machine produces pen or marker. See this, the pen or marker, that machine produces pen or marker. And today I have signed a contract with my customer that I will deliver 1 million markers. I will produce 1 million markers and then I have to deliver. So, and I will produce those markers from this same machine. So that means this machine is not held for sale, because first I have to fulfill my contract. I have to use in my production, and then only can I can sell it. So right now it's not held for sale in its present condition. Okay, then shareholder approval. But shareholder, yes, okay, what is shareholder approval? You know, sometime there are some very big assets, so for that assets you need approval of your shareholder. Okay, so until and unless you have taken approval of shareholder, it's not held for sale. But yes, sometimes shareholder approval is just like a documentation, and normally, let us say the director already owns 90% shares. The directors already own 90% of the ordinary shares. So if there will be a board meeting, So we all have major shares. We have major shares, so our vote will count, and we are right now already in the company. So if this shareholder approval is just a documentation thing, then no need. But if it is a real type of approval, then you first need to take approval, must take approval, then only it is held for sale. Okay. Same is the case. Sometimes regulatory authority approval. Yes, in many developed countries, the law is very strict. So if you want to sell something or you want to change something in your company, you first need to take a regulatory approval. So until and unless you get the regulatory authority approval, it is not held for sale. Okay. Then assets not on lease, it must be with you. For example, you have given the asset on lease to somebody, so it's not in your control right now, it's not in your possession right now, so it's not held for sale. Okay, it must be with you. Then no charges on asset. Yes, I am sure you guys have studied law paper before. Definitely now, right now you are in advanced level. So in law paper, when sometime we take loan from bank, we give our assets, we allow bank to apply charges on our asset. Remember, fixed charge and floating charge. So if there are some charges on asset, like you have given the asset to bank, or you have done the contract with bank, okay, keep my asset, I won't sell it until I return your loan, until and unless I return your loan. So in that case, again, it's not held for sale because a charge is already there. Okay. Then if terms, excellent point. If terms are normal, then held for sale. If terms are unusual, then not held for sale. What does it mean? It means, listen, if I'm following the market pattern, let us say all the market following the same pattern, and I'm also following the same pattern of selling, then it's okay. But if my pattern is unusual, conditions are unusual, listen, for example, I'm selling a property in India, but I'm saying that I will only sell this property if the buyer comes and meet me in UAE, if the buyer comes and meet me in America, United States. So this is an abnormal condition. This is not now. Or if I'm saying I will only sell if the buyer will pay me in United States, if the buyer does this thing with me, or I'm saying that I'm going to sell this asset A, but I will only sell this asset A if you buy 3 more assets from me. So these are all unusual conditions. So in that case, it's not held for sale. Okay. So if you're not following the market pattern, then it's not held for sale. Right. Then the second point, sale is highly probable. Management is committed to sell the asset, means management has started advertisement. Yes, management has make a plan to sell the asset. Advertisement has already been started. Management started to find the buyer, or we can say management has also calculated the fair value. It's very common. Whenever you need to sell any asset, first you calculate the fair value. Okay, so fair value computation is done. Now the next thing, see that there are cases. Now company doing marketing at fair value. Listen, there are 2 past paper questions which I have seen in my life, so I will share my experience of that past papers, please. This point number A was from a past paper. Okay, I will teach you many things with reference to the past paper. So when you will come to the past paper, it will be easier for you. Okay, dear student, listen. Because of recession, let me explain in my own words. Let us say it was a past paper that company planned to sell a building. And company was saying that we really want to sell it for $10 million. We can only sell it for $10 million. But suddenly a recession came, and in recession, the property prices goes down. So the real fair value of the property came down to 7 million, but the directors were very strict. Director said we will only sell it for $10 million. So now it's not held for sale. How can you sell it? Just think, the real value has come down to 7 million, and we are saying that we can only sell it for $10 million. So definitely we cannot sell it. So it's not held for sale. But yes, this is a separate different point. But sometimes it is the culture of market to do marketing 10% above the fair value, then no issue. Yes, in I have seen in my country, Pakistan as well, that if you want to sell a property and the real fair value of the property is like $1 million, for example. So what we do, we give ad, we ask brokers, the property realtors to sell it for 1.1. Okay. We write in the advertisement that we want to sell it for $1.1 million, but when party comes to us, when a certain customer comes to us during the deal, we give 10% discount. So ultimately we sell it for fair value. So this is not against held for sale, because this is the market culture. This is the market culture to do marketing 10% or 15% above. This second point also came in one paper of FR level, FR intermediate level. Okay, so be careful with these 2 points. If it is the culture of market to do fair marketing a little up above the fair value, it's okay. But if you are very rigid and the real property prices have came down and you are saying no, I will sell it for this much, so that means it's not held for sale. Definitely you can't sell it now. Now the next point, sale is expected to be completed within 12 months of its classification date. Very, very important line. Listen, from its class, it's not year end. See the wordings of the law, see the wording of the IFRS. Sale is expected to be completed within 12 months of its classification date. And sometimes, classification date is the year, mid of the year. Sometimes what we do, you classify asset as held for sale from the mid of the year. So now you need to count 12 months. You need to count 12 months from the mid of the year. From the mid of the year. Okay, so it should be sold within 12 months. Okay, but now as a student you may ask one question, sir, if not sold within 12 months of its classification date, then what will happen? If not sold within 12 months of its classification date, then what will happen? Listen, see, this is the first box, not sold. Now you need to check these, either of these two boxes will apply. The first box, if not sold because of uncontrollable factors, like we did marketing, we were ready, we did marketing, we locate the buyer, everything, but sometimes the market goes slow and things happens. So if not sold because of uncontrollable factors, plus, see this plus, asset still meets the criteria of held for sale, then you can continue it with held for sale. Go. It will still be classified as held for sale. It will still be classified as held for sale. Okay, right? But come to the second box. See this. If not sold because of controllable factors. Now, if we are culprits, we didn't do proper marketing, we didn't entertain any buyer, it was our fault, and auditor got to know our fault, auditor got the evidence that we intentionally didn't sell it, right? We did not entertain the buyers and all. So in that case we need to revert back to NCA. Now in that case we need to revert back it to NCA, right? Now the next thing, now the last condition. What is the last condition? At the date of classification, it is highly probable, at the date of classification, it is highly unlikely that management will change or withdraw its decision. Means, see the bracket, no U-turn expected. What does it mean? It means at the date of classification of held for sale, it looks like that this asset will be sold, definitely will be sold. There is nothing. It is highly unlikely that management will change or withdraw the plan. There is no such point coming in the knowledge of auditor or management that the company will take U-turn, or company will reverse his decision of selling the asset. Okay, let me give you one practical example. Listen, for example, I have a building, I have a property, okay, and I'm saying that I want to sell this property. But after a few minutes, I said one more thing. I said, I also have Apple company's shares. So if the share price of Apple companies goes up, then I will sell Apple company's share and then I won't sell this property. So that means I'm not sure of selling this property. There is some problem in my words. So in that case, it's not held for sale. It's not confirmed, because sometime I'm saying I will sell this, and then I'm saying I'll sell that. If the fair value of that shares will go up, I'll sell that. So it's not held for sale. Dear students, it's not held for sale at all. It's not held for sale at all. Okay, so these were the four major conditions. See, I have in the red marker, there were four conditions. Fourth one you can see. Then this was the third one. See, please active. Then you have, this is the second one. The second one, see, sale is highly probable. And this is the first one. Asset must be ready for sale in its immediate condition. You don't need to copy it. It's your wish. If you want to copy it, you can pause the screen and copy it as well. But if you don't want to copy it, still you will get the slides. Still you will get the slides. Okay. Now discussing some old past papers with you guys. This was the practical case came in the past paper. See, read. Company said our subsidiary is held for sale, but at the same time they transferred more businesses to subsidiary. This is a very famous question. I think it came in some 2024 past paper. I saw that in 2024 past papers. I saw this. Okay. So it is written, company said our subsidiary is held for sale. Parent company is saying that we are planning to sell this subsidiary, but at the same time parent company transferred new businesses to that subsidiary, new machineries to that subsidiary, new equipments to that subsidiary. Parent company transferred new businesses to that subsidiary. So that means there is some problem. I sometimes, as a joke, I sometimes say this, that there is a guy who is saying, I'm going to divorce my wife. I'm going to give divorce to my wife. And at the same time, he's giving a lot of gifts, properties. He's transferring properties to the wife. So there is some contradiction. Okay. Right now. So when this question came, we had to write that this point is against held for sale. This first point is against held for sale. Plus, in the same question, they got approval from shareholder to sell the subsidiary within 1 year. Within 1 year, yes, it was the same question. So it was written in the question that yes, we took the shareholder approval to sell this subsidiary, but in the shareholder approval, it was written clearly to sell that asset within 12 months. To sell that asset within 12 months. So now, if you haven't sold it within 12 months, if you haven't sold it within 12 months, now you need to take a reapproval. Now you need to take a reapproval, but you have not taken any reapproval. So now it's not held for sale. After 12 months, it's not held for sale. You need to take one more approval. Plus they also made a draft. Yes, this is a cheating. See, this is the practical life cheating. Sometime, you know what company says, that we have made a draft sale agreement. Draft sale agreement is nothing. With investment bankers, no value of such agreements. This is just fake. If auditor want to see the real agreement, not just draft agreements are designed to manipulate. There is no legal binding of these draft agreements. So sometimes, just to make auditors fool, management sometimes makes draft agreement. Be careful. Okay, so there is no such reality in those agreements. Okay, now, so this was the past paper. See, these 3 points. There was a past paper came, and even with the past paper classes, I'll also teach you this past paper. Okay, in the past paper classes, in our course, in the end, there are many past papers I have taught. Okay, and I always update those past papers with the recent ones. Okay, so you will see these things later on in our course as well. Now, very important information, and I'm sure you know it. Once you classify asset, non-current asset as held for sale, you stop depreciating it from that day, obviously. Why? Because now it's a current asset. When you shift a non-current asset into current asset, now you don't need to depreciate it. You are not allowed to depreciate it because it's a current asset. Okay. So my dear student, let's start the practical area of this standard. Very easy, just concentrate, you will understand everything. Okay, because you have recently done the impairment standard as well. Don't sleep, don't sleep. Okay, see, this is the question. They are saying an entity purchased a machine on 1st of January X2. This is the date when we bought the machine for 100,000. This is the cost. This is the cost. Very simple. This is the cost. Okay. Useful life is 10 years. Now just apply breaks. 100,000 is the cost. Life is 10 years. When no method is written, then depreciation method is always a straight line. Okay, and when no scrap value is given, scrap value is 0. So just simply do 100,000 divided by 10 years. 100,000 divided by 10 years, you will have a depreciation. You will have a depreciation of 10,000 per year. Okay, be careful. On 30th June X4, right? 2.5 years, 2.5 years. See, we bought the asset on 1st of January X2, and now we are classifying is this asset as held for sale on 30th June X4, means mid of X4, mid of X4. So simple is that we first need to depreciate asset for 2.5 years. First 2.5 years, this asset is a non-current asset, and from 30th June X4 we have to start the held for sale accounting. I'll teach you, don't worry. That's my job. That's my job. Purely my job. Okay. Now, so okay. So first of all, what we are going to do is calculate the depreciation of 2.5 years. So for the 1 year depreciation is 10,000. 1 year depreciation is 10,000. So 10,000 multiplied by 2.5, 25,000. 25,000 is the depreciation for 25,000 is the depreciation for 2.5 years. So 100 minus 25 will give you 75,000. Okay, so the first thing you need to calculate, NBV, or you can call it carrying value. Carrying value at before held for sale, carrying value at the rate of classification. Okay, now let's start IFRS 5 accounting. There are few steps. The first step is see the screen. The first step is you need to pass it through a scanner. I sometimes say you need to pass it through the scanner. The first thing is before classification impairment testing according to IS 36. First you need to pass it through the scanner of IS 36. Remember, you did IS 36. As a student, you may ask, sir, why we are passing it through IS 36? Yes, I have a logic. Because the decision to sell an asset itself is an impairment hint. Like people will ask why you are selling. People will ask why are you selling? There is something wrong. There is something wrong. So this is also the hint of impairment. This is also the hint of impairment. So my dear student, whenever you plan to sell an asset, so before classification, first you need to do impairment testing according to IS 36. According to IS 36, and we all know, according to IS 36, we always calculate recoverable amount. Recoverable amount, which is higher of two things. Number one is fair value less cost to sell, and the other thing is value in use. The other thing is value in use. Value in use. Okay, right? Listen. Now, what they are saying, on 30th June X4, see the screen, board decided to sell the asset. All conditions of held for sale were met. Value in use at 30th June X4 is 72,000, whereas the fair value less cost to sell is 65,000. Okay, be careful, relax, relax. These two things are given. Let me write it. So fair value less cost to sell, value in use is 72, VIU is 72,000, and fair value less cost to sell is 65,000. So recoverable amount is higher of these two. Please see the screen. Recoverable amount is higher of these two. So what is the higher amount? It's 72. So let's check please. 75,000 is your carrying value and the recoverable amount is 72. So carrying value is higher and recoverable amount is lower. Carrying value is higher and recoverable amount is lower. So yes, there is an impairment of 3,000. Yes, there is an impairment of 3,000. Wherever your carrying value is greater than recoverable amount, impairment is must. So how much is the impairment? 3,000. Let me make the entry of impairment. Let me make the entry of impairment. Okay, so the entry will be 3,000 P&L debit 3,000 and property plant and equipment credit 3,000. Right now it's property plant and equipment. Okay, right now we have not shifted it to current assets. Okay, so I repeat, now what are the steps? Just simply remember the step. First, you need to calculate the net book value at the date of held for sale. Then you need to do impairment testing using IS 36. You have done impairment testing. Now you tell me that asset was right now at 75 and we reduced the asset by 3,000. So from 75 minus 3, it is right now asset is at 72. Right now asset is at 72 after doing this impairment. Now what we have to do, we need to shift. Now we have to make shifting entry. Now we have to make shifting entry. See, shifting entry means you will say bye bye to PPE. And you will give birth to held for sale. Okay, so this will be the entry. C, NCAHFS debit 72,000. Be confident, please be confident. It's not difficult. Property, plant and equipment credit 72,000. NCA held for sale debit 72,000 and property, plant and equipment credit. Property, plant and equipment credit 72,000. Property, plant and equipment credit 72,000. Right? Okay, now what does this shifting entry means? Now you have said bye bye to all standard. And now let me use the word, now we are in the bubble. Of IFRS 5. Now we are in the world of IFRS 5. Okay, right? So in the world of IFRS 5, hope you did the basics in your life. In the world of IFRS 5, now see, after classification held for sale, after classification impairment testing according to IFRS 5, after classification impairment testing according to IFRS 5, and IFRS 5 is very simple, very simple. It says always, it says one word: record the asset at lower of carrying value, which was 72. See, we just shifted the asset for at 72. Now in the bubble of IFRS 5, asset just came in with 72,000. And on the other hand, you write fair value less cost to sell, which is 65. Now use your brain. Although this lower off is very simple thing, but I can give you logic as well. See, right now you are keeping the asset as 72. You are showing the asset as 72, but now you can only get one benefit from that asset by selling it. You will get only one benefit from that asset by only selling it. So that benefit is 65. So just think, you are going to take benefit of 65,000 from that asset, but you still showing it at 72. So don't you think it's unfair? Yes, it's unfair. So you need to do further impairment. So just think, asset right now is at 72 and you need to bring it down to 65. So there will be a further impairment of 7,000. So let me make the entry, the third entry at 30th June X4. P&L debit 7,000 and now the name of the asset is NCAHFS 7,000. So finally we brought down the asset to 65. It's at 65 right now. Okay, now the asset came down to 65. Okay, and yes, the date is 30th June X4. Don't sleep. I would again request you, don't sleep. Date is 30th June X4. Okay, what is the next thing? Listen, see the question. Now fair value cost to sell at 31st December X4 is 59,000. Asset went down more. Asset went down more. It's 59 right now. It's 59 now. Okay. So there will be further impairment. See, at 31st December X4, the fair value less cost to sell is 59,000. The fair value less cost to sell is 59,000. Okay, fair value less cost to sell is 59,000. So just use your brain. We have already recorded till 65. The asset we brought down at 65. So now the fair value went down 59. That means the only benefit we'll get from selling the asset is 59 only. So we should do further impairment of 6,000. So there will be entry of debit P&L 6,000 and credit NCAHFS 6,000. And what does it means? From 65 less 6,000. Now the asset right now at 59. Now the asset is at 59,000. The asset is at 59,000. Asset is at 59,000. Okay. Right. Now the real part of this question, there will be a reversal of impairment. That's the magic. So at fair value less cost to sell at 31st March X5 is 85,000. As a student, one thing may come in your mind, sir, why this asset has not yet sold yet? No issue, because 12 months has not passed. 12 months from 30th June X4 has not passed yet, so no problem. No problem at all. So now the fair value suddenly increased. Fair value has suddenly increased to 85,000. Let me show you. Let me show you the sketch. Right now, we are at 59. We are at 59, but the fair value increased to 85. So how much is the jump? How much is the jump? We can see from 59 to 85, it's 26,000. It's 26,000. Now the as a student, you may ask, sir, can we blindly go up? Can we blindly go up? Can we book reversal blindly? No, there is a restriction. There is a restriction. And what is the restriction? Let me tell you. It should, the reversal is allowed. Yes, we are doing cost model. Don't forget, we are doing cost model. Okay. We are doing, sorry, it is written here. We are doing cost model. Don't forget this. In cost model, yes, reversal is allowed. Reversal of impairment is allowed, but maximum reversal you can do is equal to the previous impairments. Not, you cannot cross the amount of previous impairments you booked. So how many impairments you book? Let's count. The first impairment is this. Impairment means all impairments before and after classification, before and after. Okay, you need to count. So this is the first impairment, 3,000. Then you have a second impairment of 7,000. Then you have a third impairment of 6,000. Can you count? Please don't sleep. 3, 7 and 6. Let me write 3, 7 and 6. This give you a total of 16,000. So in past you booked 16,000 impairment. In past you booked 16,000 impairment. So the maximum reversal you can do will be limited to this 16,000. Okay. So just think, just use one brain. 16,000 is the past impairment, and if you just blindly go up, it is 26. So always take the lower of these two as a simple 16 and 26 lower off. Okay. So the entry will be NCA reversal HFS debit 16,000 and PNL credit 16,000. NCA HFS debit 16,000 and PNL credit 16,000. Now my dear student, we were at 59. See, previously we were standing at 59. From 59 we added 16. From 59 we added 16. So the valuation, if the examiner asks the SOFP value of this asset NCA held for sale, it will be 75,000 at 31st March X5. And that's the end of this question. That's the end of this question. Okay, so be careful whenever you need to do reversal. Yes, reversal is allowed in cost model, but it is limited. Listen my word, it is limited to previous impairment. So previous impairments were 16, but this reversal was 26, so you need to restrict it to 16. Now just for your learning, listen, just for your learning, if the valuation is 70, from 59 to 70, 59 to 70, the this upward is 11. So yes, out of 11 and 16, 11 is lower. So yes, you can simply reverse 11 in that case. You can simply reverse 11 in that case. But right now, examiner has not asked you this thing. So let me make it the original. Let me make it like original question. Okay. So just giving you 1 minute to walk through this question. Not difficult. Just your confidence is needed. Your attention is needed. This is the whole question. Let me see the screen, recall it. Okay. So one more question for our practice and a little technical level I'll increase. I'll try to increase a little bit. Now the next question is question number 2. Next question is question number 2. Company bought a machine. Company bought a machine on 1st of January X5. Company bought a machine on 1st January X5 for 100,000. Keep this date in your mind. Useful life is again 10 years. So very simple. 100,000 divided by 10 years. 1 year depreciation is 10,000. Per year depreciation is 10,000. Okay. Company computed recoverable amount of machine at 31st December X6. Company computed recoverable amount of machine at 31st December X6. Now, very good question. Listen, there is no held for sale right now. There is no, just a normal life. In normal life, whenever there is an impairment, in normal life, whenever there is an impairment, we purely deal with according to IS 36. We purely deal it with according to IS 36. Okay. Now this is normal IS 36 after 2 years. Okay. Recoverable amount at 31st December X6 is 56,000. I'll do it. Now wait. Don't think about IFRS 5. Just forget it. Just forget IFRS 5. It's purely IS 36 question till now. Listen. So 1st January X5 we bought the machine. Complete X5 will depreciate and complete X6. Why? Because the impairment is done at 31st December X6. Okay. So per year depreciation, see the screen. Per year 100,000 divided by 10 years, it's 10,000. So per year depreciation is 10,000. First year it's 10,000. Second year is 10,000. So 10 and 10, 20. So can you please subtract its NBV? NBV is 80,000. NBV at 31st December X6 is 80. Now can you see this question? What is your recoverable amount? Your recoverable amount, see the screen. Your recoverable amount is 56,000. Your recoverable amount is 56,000 at 31st December X6. Okay. So when your recoverable amount is 56, can you use your brain? Your NBV is 80, your carrying value is 80,000 and your recoverable amount is 56. So there is a straight away impairment of 24. Straight away impairment of 24. So the entry of impairment will be P&L debit 24,000 and property, plant and equipment credit 24,000. P&L debit 24,000 and property, plant and equipment credit 24,000, right? Okay, so this is our first impairment and there is no IFRS 5 till now. Now use your brain. Once you once you impair or revalue an asset, once you change the value of an asset, now in future, this updated value divided by remaining life will be your depreciation. In future, this updated value divided by remaining life. See, so it will be 56,000 divided by 8 years. See, the original life was 10 years and 2 years have been passed. Original life was 10 years and 2 years have been passed, so 8 years left. So 56,000 divided by 8 is going to be 7,000 is the depreciation for next year. 7,000 is the depreciation for next year. So 56 minus 7 is 49. Now NBV at 31st December X7 is 49. Just for your updation, just for your activeness, I'm saying, see, there is a reduced depreciation of 3,000. There is a reduced depreciation. Later on in this question, I'll use this concept. Even I taught you this in IS 36. Remember IS 36 I taught you. See, when we didn't book any depreciation, sorry, when we didn't do any impairment, our per year depreciation was 10. Our per year depreciation was 10,000, but now our per year depreciation is 7 after impairment. So there is a reduced depreciation of 3,000. See, in this December X7 year, there is a reduce. We get the benefit of reduced depreciation of 3,000, or you can say it, depreciation is reduced by 3,000. Okay. So now this date, now in this question, this 31st December X7 is the date of held for sale. 31st December X7 is the date of held for sale. We'll apply everything which I just taught you. We will be applying everything which I just taught you. Listen. So on 31st December X7, see the words. On 31st December X7, board decided to sell the asset. Yes, all conditions of HFS were met. Now what they are saying, VIU at 31st December X7 is 40,000 and fair value less cost to sell is 35. Don't worry about it. Okay, so we need to pass it through different scanners. The first scanner, see, this is the first scanner. Before, see the screen, before classification, IS 36 impairment testing, first scanner, remember. So in IS 36 impairment testing, you need to calculate recoverable amount, and recoverable amount is higher of these two. VIU is, I think, 40,000 and fair value less cost to sell is 35,000. VIU is 40,000 and fair value less cost to sell is 35,000. Fair value less cost to sell is 35,000. So recoverable amount is higher of these two. So your recoverable amount is 40,000. Your recoverable amount is 40,000. Okay. Now just use your brain. Your NBV is 49. See. And recoverable amount is 40. NBV at the date of held for sale is 49 and recoverable amount is 40,000. So your carrying value is higher, but your recoverable amount is lower. So there is an impairment. There is an impairment of 9,000. There is an impairment of 9,000 P&L debit and property, plant and equipment credit of 9,000. P&L debit and property, plant and equipment credit of 9,000. P&L debit and property, plant and equipment credit of 9,000. Okay, right. Now what's the next step? We are ready for shifting. Now we'll make the shifting entry. And yes, we know from 49,000 we were at 49 less 9, 49 less 9. Now we are at 40,000. Now we brought down the asset to 40. So we'll make the shifting entry of 40,000. And what is the shifting entry? We'll say bye to PPE and we'll give birth to NCA HFS. Debit 40,000 and property plant and equipment credit 40,000, NCA HFS debit 40,000, and property, plant and equipment credit 40,000. Okay. Now, once you make this entry, this is very famous entry. Once you make this shifting entry, now you said bye bye to all assets, all IS, and we are in the bubble of IFRS 5. Now, what IFRS 5 says? IFRS 5 is very simple guy. IFRS 5 says record the asset at lower of carrying value. Carrying value is 40 because we brought down the asset to 40. Carrying value is 40 and fair value less cost to sell right now it's 35. So IFRS 5 says to record this asset at lower of carrying value and fair value less cost to sell. Carrying value and fair value less cost to sell. So definitely there is a further impairment of 5,000. There is a further impairment of 5,000. Why? Because we are showing at the asset at 40. We are showing the asset at 40, but the only benefit we are going to obtain it from asset by selling it, and that benefit is only 35. That benefit is only 35. So yes, there is a further impairment of 5,000 P&L debit and NCA HFS credit 5,000 P&L debit and NCA HFS credit 5,000. Okay. Right. So after this entry, after this 5,000 further impairment, now we are at 35. We are at 35. The last part of this question, just 2 minutes of this question, please. So the asset is at 35,000 right now. Okay. Don't forget this. Now see the question. Now see the question. The fair value less cost to sell at 30th June X8 is 80,000. Now reversal is there. Reversal is there. See, wait. We are at, please just, I just need your efforts now. It's little efforts. 35 and the river, now the new fair value is 80. So apparently we can do 45 upward. Apparently it looks like we can go 45 upward, but yes, for reversal there is a limit. For reversal there is a limit. For reversal there is a limit. Okay, just make a box of previous impairment. Let me show you the previous impairments. Let's count. This is the first impairment, first. This is the second impairment, 2. And this is the third impairment, 3. There are 3 impairments. See the screen right now. See the screen actively. One is 24,000, then 9,000, and then 5,000. Just let me write down. 24. Okay. Then you have 9, and then you have 5. But there is only one problem. There is only one problem here. One problem here. Can you see? I hope you are active. This 24,000 we booked. This 24,000 we booked in the middle of the journey, like at 31st December X6. And then after booking this impairment, we booked depreciation of 1 year. See, we booked depreciation of 1 year, which is 7,000, which is 7,000 C. So just think, if we wouldn't have done this impairment, our normal depreciation for each year was 10. Our normal depreciation for each year was 10, but after this impairment our new depreciation is 7. That means we took advantage of 3,000 of reduced depreciation. We took advantage, we enjoyed, or in other words we call it, we booked an income of 3,000 of reduced depreciation. That means we have already taken a benefit of reduced depreciation of 3,000. So now that 3,000 needs to be subtracted from this, because we have already enjoyed my dear student, we have already enjoyed the benefit of 3000 reduced depreciation out of 24. So only 21 we can reverse. I hope you remember IS 36. I repeat, sorry. 24,000 was the impairment, and standard says whatever expense you booked in past you can reverse it, whatever loss you faced in past you can reverse it. But just use your brain, we didn't book the loss of 24. In reality we booked the loss of 21 because 3000 benefit we have already enjoyed in the form of reduced depreciation. Okay, so now we can only reverse 21 plus 9 plus 5, that is 35,000. That is 35,000. Okay, so now can you use your brain? Just keep 35,000 here, and this amount is 45. 35 and 45, what is the lower amount? Because maximum you can do 35, not more than 35. So you will book NCAHFS debit 35 and PNL credit 35. Now my dear student, we were existingly before this thing we were at 35. We were at 35,000 at 31st December X7. Now we increased further to 35, more 35. So at the year end, sorry, at 30th June X8 in the SOFP, we'll report this asset for 70,000. We will report this asset for 70,000. Okay, so my respected student, this is the new thing I taught you. This, see this is the new thing I taught you in this question. In the previous question which I taught you, there was no such case of reduced depreciation, because in the previous question all impairments were done at before and after, right at the date of classification. But in this question impairment was done before 1 year of held for sale, before 1 year of held for sale. So there was some impact of reduced depreciation as well. There was some impact of reduced depreciation as well. Okay, now a few things. First, read the question. Take your time. We have time. Take your time. Just see it. Read the question again. Please check it out. Now, just for your easiness, I have written certain steps. Whenever you find a cost model in IFRS 5 and you need to do held for sale accounting, there are a few steps. First of all, calculate depreciation till the date of held for sale. Depreciation till the date of held for sale. Then you need to do before classification impairment testing of IS 36. According to IS 36, the first scanner. Then you have to make shifting entry, and then after classification impairment testing, which is done according to IFRS 5 and which says to record the asset at lower of carrying value and fair value less cost to sell. Okay, I hope you got the message. Okay, now one more question. Now we are moving towards revaluation model. Now the question number 3 is related to revaluation model. Okay, so IS 16 revaluation model. Okay, now company purchase a machine for 100,000 on 1st January X1. Useful life is 10 years. Again, go very simple. Again, go very simple. 100,000 is the cost of machine and life is 10 years. So 100 divided by 10. 100 divided by 10 is 10,000. Okay. So 10,000 per annum is the depreciation. Go very simple. The asset was revalued for the first time on 31st December X2. X2 after 2 years. After 2 years. Okay. So first we need to depreciate it for 2 years at 120,000. Right. Now no need to read it further, just this 1.5 line is enough for us. 1.5 line is enough for us. Let's start. So 100,000 was the cost, and first we need to depreciate this asset for 2 years. Simple. So 100 divided by 10 years is 10,000 is the first year depreciation. Okay, and then 10,000 is the second year depreciation. So we'll have an NBV of 80,000. We'll have NBV of 80,000 at 31st December X2. We'll have NBV, net book value, of 80,000 at 31st December X2. Now, what is the fair value? What is the fair value at 31st December X2 is 120, because now we are using revaluation model, and revaluation model, whenever there is a change in fair value, we have to revalue. So now the revalued amount is 120. Just use your brain. We were at 80. From 80 we are going 120. From 80 we are going to 120. So there is an upward revaluation of 40,000. There is an upward revaluation of 40,000. Let me make the entry. The entry will be, the entry for upward revaluation, shortcut entry, PP debit and revaluation reserve credit. Property, plant and equipment debit and revaluation reserve credit. Property, plant and equipment debit and revaluation reserve. Property, plant and equipment debit and revaluation reserve credit. Okay, property, plant and equipment debit 40,000 and revaluation reserve credit. Sometimes we call it revaluation surplus or OCI, whatever you name it, looks good to you, but I write this name. Okay, now the next thing is, once you revalue the asset, now the updated amount you will use for future depreciation. Updated amount divided by remaining life. Okay, so remaining life now is 8 years. The updated amount is 120,000. See the screen. So it will be, see the screen please. So it will be 120 divided by 8 years, you can see. So this will be 120 divided by 8 is 15,000. Okay, so now 120 minus 15, you will get NBV of 105,000 at 31st December X3. 105,000 at 31st December X3. Now the turning point of this question, listen to me. 31st December X3 is the date. 31st December X3 is the date on which you are going to classify it at held for sale. Okay, so now what are these steps? If you are using revaluation model? See, the first step is depreciation. Simply do the depreciation till the date of revaluation, till the date of held for sale. Okay, we have already done depreciation till 31st December X3. The second step is now first revalue the asset. Revalue means bring it to fair value. Can you see the fair value? Yes. The fair value at 31st December X3. See the screen. The fair value at 31st December X3 is 100,000. The fair value at 31st December X3 is 100,000. So let's revalue it. Listen, this is 100,000. So use your brain. NBV was 105 and the fair value is 100. NBV was 105, the fair value is 100. So it is devalued by 5,000. Yeah, now use your common sense. Listen, asset first went up by 40,000. Assets first went up by 40 and then it went down by 5. So whenever there is an upward revaluation and then you have a downward revaluation, so first you need to cancel the reserve. So the entry will be revaluation reserve debit by 5,000 and property, plant and equipment credit by 5,000. Revaluation reserve debit and property, plant and equipment credit. Why? Because you have an existing revaluation reserve. You have an existing revaluation reserve with you. You have an existing revaluation reserve with you. You have an existing revaluation reserve with you. Okay, so now the asset came down to 100,000. Now the asset is at 100,000. Now my dear student, use all previous steps which I taught you in last two questions. The next thing is do before classification impairment testing using IS 36. Use before classification impairment testing using IS 36. Now for IS 36 you must calculate recoverable amount. For recoverable amount you must know VIU, value in use. See the question. Add on this date all the criteria for being held for classified as held for sale were met by the asset. Cost to sell at that date were 9,000, but VIU is 105,000. Okay. So if you want, see the step number 3. If you want to do impairment testing using IS 36, you need to calculate recoverable amount, and in recoverable amount is the higher of two things. Recoverable amount is the higher of two things. One is value in use, which is 105,000, and the other thing is fair value less cost to sell. Fair value less cost to sell. So hope you remember the fair value was 100,000. The fair value was 100,000. We just see this is the fair value at 31st December X3. Fair value was 100,000 minus cost to sell is 9. See the question I've just showed you. 100 minus 9 is 91,000. 100 minus 9 is 91. Now can you see, out of this fair value less cost to sell and value in use, which one is higher? Higher is 105. So your recoverable amount is 105. Your recoverable amount is 105,000. 105,000. Now let's do impairment testing. Right now we are at 100,000. Right now we are staying at 100. Our carrying value is 100. We brought down the asset to 100, but the recoverable amount is 105. Do you think any impairment is needed? No. Impairment is only needed. Impairment is only needed whenever carrying value is higher and recoverable amount is lower. But in this case, carrying value is lower and recoverable amount is higher, so there is no impairment. Yes, we did impairment test, but the asset is cleared. The asset is clean. There is no need of any impairment. See, there is no need of impairment. You just did previous questions as well. So in that case, there is we did impairment testing. Yes, we just checked the asset for impairment, but no problem in that asset. So just simply do shifting entry. See, the fourth step is shifting entry. Now what does it mean of shifting entry? Shifting entry means you will say bye bye to non-current asset, the PPE, and you will give birth to held for sale. So this will be NCA HFS debit 100 and property plant and equipment credit 100. Okay, and once you make this entry, you enter in the bubble of IFRS 5. And IFRS 5 is very simple. IFRS 5 always says one line, that record the asset as lower of carrying value, which is 100, and the other thing is fair value less cost to sell, which is 91. Carrying value and fair value less cost to sell is 91. Okay, so just use your brain. We are right now at 100, but the only benefit we'll obtain from that asset is by selling it, and we'll obtain only 91. So yes, there is an impairment of 9,000, and now make the entry P&L debit 9,000 and CHFS credit 9,000. Now as a student you may ask one question, sir, why are you debiting P&L? Because still we have a unused revaluation reserve of 35,000. Still we have an unused revaluation reserve of 35,000. Remember 40 minus 5. Yes, we have unused revaluation reserve of 35, but when you enter in IFRS 5 bubble, there is no entries of revaluation reserve. You can only book P&L. Okay, you can only book P&L when you enter in IFRS 5 world. Now as a student, one more question you may ask. We just book an expense, we just book an impairment of 9,000, which is normally equal to the cost to sell. Cost to sell was 9,000 if you are active. So what if in future this value goes up? What if in future this value goes up inside IFRS 5? So yes, you can do reversal of maximum 9,000. That's it. Maximum 9,000 reversal is allowed. In future, max 9,000 reversal possible in P&L. That's it. In future, maximum 9,000 reversal is possible in P&L. So that's the end of this question. Just you need to, these slides are very important. After the class, just give 15 minutes to yourself and go through these slides, so it will give you a confidence. Okay, it will give you more clarity. Listen, So in revaluation model, these are the steps. See the screen. Number one, first you need to book depreciation till the date of revaluation. Sorry, till the date of held for sale. First you need to book depreciation till the date of held for sale classification date. Then there is one extra step. Then first you need to do revaluation using IAS 16. And for revaluation, you need to bring asset to fair value, not fair value less cost to sell. Be active. Then you need to do all the previous step which I taught you in cost model. You need to do impairment testing before classification using IAS 36, then shifting entry, then after classification impairment testing using IFRS 5. That's it. Still you want to go through the question? You may. Please check the question. Okay, dear student, now we are moving to the last area of this standard, and that is discontinued operation. Discontinued operation. Listen to me, it's not difficult. You can easily understand it. For example, I have a company and I deal in two products, oil and shampoo. Okay. Oil generates $8 million profit this year, and shampoo sector generates $2 million. But before the year end, I have planned to discontinue this oil. Like, for example, I have sold my oil segment. I have sold my running business of oil segment. Okay. Right. So what does it mean? Next year there will be no oil, there will be no oil related profits. So if I do, for example, if I do 8 plus 2 total, if I show total profit of $10 million to shareholders, $10 million total profit to shareholders, and you know these are the profits from operations, and normally this is the perception of shareholders that operations are ongoing. Yes, operations are ongoing. So if I report total profit of $10 million to my shareholders, they will expect the same profit next year. They will expect the same profit next year, but that is not good, because in next year there will be no oil. There will be no oil. There will only be shampoo. So that means shareholder will be fooled. Shareholder will be misguided. So now what standard says that in the income statement and SOCI, you have to break up. You have to show a breakup presentation. Like this shampoo is your continuing operation. Shampoo will come in the continuing operation, and oil will be reported in the discontinued operation head. In the discontinued operation head. So the shareholder will not be misguided. Okay, let me show you a sample. See, like this. See this, like this. First of all, there will be a P&L of continuing operation. Open your eyes and see. And then in one single line, you have to report the profits of discontinued operation, so that shareholder won't expect anything from discontinued operation next year, because this won't be with us. Okay, this is the game. Now, it's all theory, but very interesting theory, and it comes in exam. Please, only last 15-20 minutes and the class will be over. The first line, HFS, we were doing held for sale. Held for sale is the presentation of SOFP. Held for sale is connected to current and non-current asset. Okay, so that is the presentation of SOFP. But discontinued operation is the presentation of SOCI. This is the first message you must know. For discontinued operation, the operation must meet the definition of component of an entity. The operation must meet the definition of component of an entity. Component of an entity means its revenue, cost, and cash flows must be separately identifiable. Just think, if these revenues, cost, and cash flows wouldn't be separately identifiable, how will I report it separately? How will I report it separately? Use your brain. So it must, only those parts will be treated as discontinued operation, those who meets the definition of component of an entity, and it means your revenues, cost, and cash flows must be Separately identifiable, must be separately identifiable. Then we have discontinued operation may be a geographical segment or separate major line of business. Yes, hold. Listen, it is possible that we have different products like shampoo, oil, toothpaste, different products. So we are dealing in different product and we have discontinued one product, or we have sold one product. So if you have different separate major line of business, see this, if you have separate major line of business and you are saying bye bye to one line of business, still it is discontinued. Or is it is also possible that you have only one product, like I only deal with shampoo, but I deal with three separate geographical locations. Like I have operations in India, I have operation in Turkey, and I have operations in Nepal. So now I have decided to discontinue my operation in Turkey. So it's a big thing that one complete geographical location I'm going to close down. So next year there will be no profits coming to me from Turkey. So now I need to again use this presentation of discontinued operation. Okay, so it applies both ways. Like if you have separate major line of business, again you going to apply it like this. Or if you have geographical segmentation, if you have geographical segmentation, like you are in different geographical location and you are coming out of one geographical segment, again it's a discontinued operation. Okay, so it's very practical. Now subsidiary acquired for resale also classified as discontinued operation. Now wait, let me give you explanation. Listen, sometime what we do, we structurize our company in such a way that we are a single company and we have different division, 1 2 3 4. Like in audit firms, take the example of PwC. PwC has audit division, PwC has tax division, advisory division, different divisions. Okay, so if we are of this structure, we are a single company with different divisions and we are selling our one division, again it's discontinued operation. And if we are working like a group, so it's a parent company with 4 subsidiaries, subsidiary 1, subsidiary 2, subsidiary 3 and subsidiary 4. Parent company with 4 subsidiaries, subsidiary 1, subsidiary 2, subsidiary 3, subsidiary 4. And now we are planning to sell subsidiary 1. So again this will be a discontinued operation. Why? Very simple. Because if we don't separate the profits of this subsidiary S1, the people will think we are very big bodybuilders. We are big body. This group is very giant bodybuilder group. But in reality, one hand is going to be cut soon. One hand is not going to be the part of this group. So definitely we need to report it is as a discontinued operation. Okay. Then we have, if an operation is discontinued, very important, golden lines, it comes in exams. If an operation is discontinued in the current year, it must be reported as discontinued in the last year comparatives so that shareholder can check the performance. Great lines. Great lines. Let me explain. Listen, this is the game. For example, in 09 you discontinued oil. Okay, so the profits of shampoo is 2 million and the profit of discontinued operation, which is oil, is 8 million. So this is the requirement of the standard, that you go back last year and in the last year you need to show performance in the comparative. Obviously with the current year accounts, these comparatives will go to shareholders, but you need to show this breakup of last year as well, that last year from continuing operation you made 1 million and from this oil you made 12. So what is the objective of this comparatives, this comparative presentation of last year of discontinued operation? Listen, you know what is the reason? In this way shareholder will come to know that your decision is correct or wrong. See, in the last year you made $12 million from discontinued operation, and in the current year you made $8 million. That means you have taken right decision. That the operation which you just discontinued, was a sinking ship. It's better You came out of it. It's very good decision that you came out of it. It was a sinking ship. Just see the profits. Last year, this discontinued operation made $12 million, and this year only $8 million. So this was a very good decision. You came out of it. So that's why Standard has ordered us to show comparatives in with discontinued operation. But now read one more line. But if an asset is classified as HFS, now I'm talking about the held for sale. If the asset is classified as held for sale in the current year, it won't be classified as HFS in the last year comparative. Now no need. If the asset is classified as held for sale in the current year, no need to show that asset as held for sale in the comparative. You know why? Because last year it was non-current asset and this year it came to current asset. So shareholder will come to know that it shifted from non-current to current, non-current to current. This will give them indication. Now the next thing is one more thing with the red pen. See, in the statement of cash flows, in statement of cash flows, IS 7 SOCF, separate cash flows of discontinued operation are reported for operating, investing and financing activities either on the face of the cash flow statement or in the notes to the accounts. Yes, very good. SOCF, the statement of cash flow, is also one of the performance statement. So for discontinued operation, you have two options. Either on the same cash flow statement, you need to show on the face of the cash flow that how much cash flows is generated for operating activities, investing and financing activities regarding this discontinued operation. You can show on the face of your cash flow of these three: operating, investing and financing cash flows of discontinued operation, or the same thing you can do in the notes to the accounts, or the same thing you can do in the notes to the accounts. Okay, right? Be careful with this thing. Right? In the red pen. Now I'll show you some past papers. Listen, this came in past paper, I think 2018. Sometimes it's become a judgmental issue. See, sometimes it's a practical issue I'm discussing now, that whether the operation is a separate major line of business or not. In that case, we need to check the relevance and materiality of that operation. Yes. See, the wordings of standard, that it should be a separate major line of business. So for example, like we have businesses in Turkey, Indonesia and Malaysia. Yes, I'm using. In Turkey, out of our 50 shops, we had 50 locations and 50 shops in Turkey. We just closed one shop. So this one shop is immaterial. So it's not a separate major line of business, and now you don't need to scare your shareholders. That's wrong. But yes, if you are going to sell the major shops, or if you are selling the shops which are of key importance, the key areas, the heart of Turkey, the shops which were in the heart of Turkey, the shops which generated like your 60% of the revenue of Turkey. So if you are selling such things which are relevant for your group, which are material for your group, so now again it will come as a discontinued operation. So that's why I have written it's a judgmental issue. Sometimes it's a judgmental issue. Let me use one word, please don't get confused. Sometimes by quantity things are immaterial, but by qualitative aspect of materiality, hope you have done in your audit class, sometimes things are material because of qualitativeness. Okay, so such judgments need to be verified very carefully. Okay, so this things also come in the exam. Also, yes, very good. Sometimes HFS criteria is not met directly in case of parent and subsidiary issue. Now wait. Let me tell you this story. This story also came in one of the past paper. I'm sure you will understand it. See, First of all, right now, parent company owns 60% shares in S company. Parent company owns 60% shares in S company and NCI owns 40%. Can you see the right now picture? Yes, this is the correct. Now what happened? Today, S company issued more convertible loan notes to NCI. Today, with these holding percentage, S company issued convertible loan notes, more convertible loan notes to NCI. And you know what do you mean by convertible loan notes? Convertible loan notes are the loan notes which are convertible into ordinary shares in future. Convertible loan notes are the loan notes which are convertible into ordinary shares in future. So when these when these convertible loan notes will be converted into ordinary shares, there will be new holding percentage of this. Wait. The new holding percentage will be 70% of NCI, and let me write with black pen, and 30% of P. 70% with NCI and 30% with P. When these convertible loan note will be convertible into ordinary shares, then NCI will have more ordinary shares. So in future, the holding percentage will be like that, 70-30, 70-30. Okay. So now that means control is gone. Okay. So control is gone means indirectly you have sold your power. Indirectly, parent company has sold this subsidiary. So now will this subsidiary be classified as held for sale? Yes, it will be classified as held for sale. Why? Let me give you logic. Let's read the paragraph first, and then also, if sometimes HFS criteria is not met directly, in case of parent and subsidiary issue, potential shares means these convertible loan notes. Potential shares issued by S company to others. In that case, we need to prove HFS criteria through intentions of P company by looking at the substance of the transaction. Now wait. See the red marker lines, the same thing which I explained. Now read the question. Should P company classified it as HFS? Yes, because the issue of convertible loan note happened during the rule of P company. You know, when these convertible loan notes were issued to NCI, P company was the powerful guy. P company had the control. That means these all things happened with the consent of P company. So in that case, P company intentionally lost his control, which means they had intention to lose control. Yes, then this is held for sale. This is held for sale. Now the last thing. This is a very interesting area. See, there is one concept, it is written in your book as well. Abandoned assets. What does it mean? Assets which are abandoned means we have stopped the usage, means we have discontinued using it, but no intention to sell. Abandoned assets means we just stopped using it. But we have no intention of sale. Okay. That's why strictly we cannot classify them as held for sale. Because no intentions of sale. Only we have stopped. Giving you one example. Like for example, I'm the owner of an institute, you know. So I have, let us say, 3 branches. Today I just closed down one branch. I didn't say that I'm going to sell the assets. I'm just closed down. So when I'm saying only close down the branch, so it means it's not held for sale, because you know the definition of held for sale today in my today's class I taught you. Held for sale is the asset whose carrying value is principally recovered through a sale transaction, not from continuing use. So there is no intention of sale, so no more held for sale, don't think about it. But yes, see, but if those abundant assets meet the definition of operation, then in SOCI we'll report them as discontinued operation presentation. Yes, listen. For example, I have three branches of my institute, three major, all three branches are very super hit, right? So today I closed down one branch, closed down one very important branch, but I'm not saying I'll sell the assets, only close down. I switched off. So yes, in terms of earning, there will be no earning. There will be no earning from that branch in future. There will be no earning from that branch in future. So in the income statement, I need to report that branch as a discontinued operation. So my shareholders get aware. My shareholders get aware of that branch, that there will be no future profits. So see these lines. See these lines, point number 3. But if those abundant assets meet the definition of operation, then in SOCI will report them as discontinued operation. As discontinued operation. As discontinued operation, right? On 1st December, see there is a question. On 1st December X3, company became committed to plan to sell a manufacturing facility. It's a short question. And has already found a potential buyer. Okay, excellent. The company does not intend to discontinue the operation currently carried out in the facility at 31st December X3. See the line. There is a backlog of uncompleted customer orders. Today I taught you this. The subsidiary will not be able to transfer the facility to buyer until after it ceased to operate the facility and has eliminated the backlog of uncompleted customers order. Now listen, this is not expected to occur until September 20x4. Very simple, very simple. I would say, see, our assets are occupied in making a backlog of order. We have already signed a contract of delivering some goods to customers. Big order we have taken. So first we need to complete that order, then only we can sell it. First we need to complete that order of customer and then we can only sell it. So what does it means? It means it's not held for sale. It means this facility is not held for sale in its current situation. Remember, it must be held for sale in its present condition. So it's not held for sale in its present condition. Not held for sale. Okay. Now one last question, just an extra question. For example, we are parent company. Let me show you here. We are parent company and we have 4 subsidiaries. We are parent company and we have 4 subsidiaries, S1, S2, S3 and S4. And now I have planned to sell this subsidiary. Now what I will do in my SOFP and in income statement. Listen, in income statement, the profits of this subsidiary will be reported in one line, that is discontinued operation. Okay, we will not be doing line by line consolidation for this subsidiary. No revenue adding, no cost of sales adding, nothing. This subsidiary will be reported in discontinued operation, just one line. So that, why? Because so that shareholder won't expect anything from this subsidiary in future. And in SOFP what we'll do, in SOFP this subsidiary will be reported in current assets, just current asset. No line by line consolidation, no PPE adding, no intangible asset adding, nothing. This subsidiary will be treated as a disposal group and it will be reported in one line in current asset. Why? Because just think, if we add it like line by line consolidation, people will think we are bodybuilder. People will think we are very heavy, but in reality, one hand is going to be cut soon. So that's why in the SOFP, we'll report it as a current asset. Okay. So I hope you like the class. please revise the concept. And that's time to say goodbye. I'm your trainer, Mustafa Ahmed Mirchawala from Mirchawala Sub Accountancy. Thank you and take care. Bye bye.